You know when you look at your grocery bill or the cost to fill up your gas tank lately, and you just kind of wonder what exactly is going on with prices? Well, today, we're looking at a central paradox that literally directly affects your daily cost of living. Think about it. Why on earth would a central bank decide to hold interest rates completely steady when inflation is aggressively spiking back up into double digits? It seems totally counterintuitive, right? I mean, usually when prices surge, central banks hike rates to cool things down. But in this explainer, we're going to look at a specific instance where the decision was to hold firm. We'll connect the dots to see exactly how this high-level macroeconomic decision trickles all the way down to your daily expenses.
Welcome! Today, we are breaking down a truly fascinating piece of economic strategy, the State Bank of Pakistan's crucial monetary policy statement from June 15, 2026. Now, this isn't just dry financial jargon. It is an absolute masterclass in economic tightrope walking. The SBP is currently managing a really delicate balancing act. They're trying to shield the local economy from massive global shocks while simultaneously keeping a lid on domestic prices and trying to foster growth. It's like a giant puzzle, but we're going to break it down and make it perfectly clear.
All right, let's dive right into this. Here is our roadmap for today. First, the 11.5% decision. Second, global shocks and local inflation. Third, the 3.7% growth. Fourth, reserves and fiscal health. And finally, the economic road ahead.
Starting off with Section 1, the 11.5% decision.
Now, what's really interesting here is the weight of the institution behind this decision. The State Bank of Pakistan's Monetary Policy Committee, or the MPC, is the ultimate authority on setting the monetary direction for the country. These are the folks analyzing the incoming data, weighing the risks, and making the really tough calls that determine the cost of borrowing for everyone. We're talking massive corporations all the way down to everyday consumers like us.
And boom, here is the massive number that came out of that June 15th meeting, 11.5%. The MPC evaluated all the unfolding macroeconomic developments, they looked at all the risks, and they decided to keep the primary policy rate completely unchanged at 11.5%. They didn't raise it to fight the recent inflation spikes, and they didn't lower it to stimulate more immediate growth. They simply held the line.
So, the big question is why? Why hold steady? Well, the committee stated the current monetary policy stance remains appropriate to guide inflation towards the target range of 5 to 7% over the medium term. This is absolutely crucial to understand. Despite the immediate intense pressures and the recent spikes we're seeing right now, the SBP's ultimate baseline plan hasn't wavered one bit. They genuinely believe that keeping the rate at 11.5% is the correct, forward-looking stance to eventually drag inflation all the way down to that manageable 5 to 7% window over the medium term. They're playing the long game here.
Moving right along to Section 2, global shocks, local inflation. Check out this wild jump. This is year-over-year headline inflation. Back in March, it was sitting at a relatively manageable 7.3%. You know, it seemed like things were actually cooling down. But then, inflation unexpectedly surged right back into double digits. It jumped to 10.9% in April, and then climbed even higher to a staggering 11.7% in May. This sudden reversal is exactly the kind of crazy volatility the MPC is trying to navigate.
So, what exactly caused this sudden spike? Well, the main culprit identified by the SBP is the prolonged Middle East conflict. The effects of this conflict have basically bled into the local economy, with a sort of 1-2 punch. First, you've got the direct impacts, a sharp hike in domestic energy prices. When global oil prices are elevated due to conflict, you feel it directly at the pump. Second, you have the indirect impacts, the subsequent rise in transportation and production costs. Because it costs more to fuel trucks and power factories, the cost of manufacturing and delivering everyday goods goes up. It's hitting everyday wallets from multiple angles simultaneously.
And honestly, it's not just energy. Food inflation was significantly pushed up by an unanticipated surge in the prices of wheat and wheat products over the last couple of months. All of this combined has caused core inflation, which, by the way, strips out some of the more volatile items, to edge up as well, hitting 8.2% in April and 8.7% in May. Because of this combo of global energy shocks and local food price surges, the MPC's frank assessment is that inflation is likely going to remain in double digits for the next few months before it gradually begins to ease.
Okay, Section 3, the 3.7% growth.
Now, while those inflation numbers are certainly grim, there are some real silver linings to be found here. Despite the elevated prices, the austerity measures, and just the general economic uncertainty, the provisional real GDP growth estimate for the fiscal year 2026, FY26, came in at a surprising 3.7%. This is actually a notable step up from the 3.2% growth recorded in FY25. The SBP points out that this outcome reflects the dampening impact of the Middle East conflict and necessary austerity measures, which actually means the growth momentum before the conflict was notably higher.
So where did this growth actually come from? Breaking it down, that 3.7% growth was primarily underpinned by strong performances in the services and industry sectors, along with a highly meaningful contribution from agriculture. Interestingly, and this is a fantastic bright spot honestly, large-scale manufacturing posted a very robust growth of 6.5% between July and March of FY26, though the SBP does expect this manufacturing growth to moderate just a bit in the final quarter of the fiscal year based on recent trends.
But look, we have to be realistic about the future. While FY26 saw respectable growth, the MPC warns that FY27 faces some serious hurdles. The spillover from the ongoing Middle East conflict is expected to continue moderating activity in both the industry and services sectors. On top of that, there are subdued prospects for agriculture. Initial info on the kharif crops indicates they are facing some really challenging weather conditions. Combine all those factors with ongoing austerity measures, and the growth outlook for FY27 is going to be heavily weighed down.
Which brings us to Section 4, Reserves and Fiscal Health.
Before we look at the numbers, let's just quickly define a piece of jargon the SBP uses repeatedly: fiscal consolidation. For the armchair economists tuning in, this simply means the government's strategy to reduce its deficits and accumulate surpluses. Think of it exactly like a household strictly tightening its budget to pay off credit card debt and build up a savings account. In this specific context, the SBP notes that this effort is being primarily driven by expenditure restraint, meaning the government is strictly controlling its spending to keep its financial house in order.
And this perfectly illustrates the success of that strategy when combined with external support. So back in April 2026, the country faced a current account deficit of $0.3 billion, mainly because a surge in energy imports widened the trade deficit. Kind of scary, right? However, resilient workers' remittances helped offset this. But more importantly, the successful completion of reviews for the IMF's Extended Fund Facility and Resilience and Sustainability Facility, along with increased official inflows, provided absolutely critical support. Because of all this, by June 5, 2026, the state bank's foreign exchange reserves had increased to a very healthy $17.2 billion, and by the end of June 2026, they're projected to hit $18 billion.
Think of this reserve buildup as a massive financial shield. This ongoing strategic management allows the state bank to facilitate necessary foreign exchange purchases, and it provides the critical support needed for the country to smoothly meet its external financial obligations, even when the global environment is super challenging.
Tracing the government's fiscal stepping stones shows a clear, restrained path forward. Now, the Federal Board of Revenue, the FBR, did have to revise its revenue target downwards to around 13 trillion rupees for FY26 due to moderated revenue growth. But despite that, the fiscal consolidation efforts remain broadly on track. Why? Because of that expenditure restraint we talked about earlier. The government still expects to achieve a primary balance surplus of 2.5% of GDP in FY26. And for FY27, they're targeting a 2.0% surplus. To maintain this, the MPC firmly reiterated that it's imperative to implement structural reforms immediately, specifically measures aimed at broadening the tax base and reforming public sector enterprises, or PSEs.
Finally, Section 5, the economic road ahead.
So, having looked at the growth, the inflation, and the fiscal health, we can see the MPC is basically watching a massive dashboard of warning lights. The outlook for inflation easing after the next few months is highly dependent on a bunch of looming risks. They're watching geopolitical developments closely. They're monitoring how much global oil prices pass through to domestic fuel prices. They've got to factor in the magnitude of upcoming adjustments in power and gas tariffs. They are definitely wary of potential fiscal slippages if the government fails to maintain its spending restraint. And finally, they're watching highly uncertain food prices amidst challenging weather-related events. Make no mistake, any one of these macro risks directly threatens to push your consumer costs higher.
Which leaves us with this final, provocative thought to ponder. We've seen how the SBP is using forward-looking monetary policy and demanding consistent fiscal consolidation to maintain stability. But looking at the volatile state of the world, will this proactive management and the push for rapid structural reforms actually be enough to shield the economy from the next inevitable global shock? Can this 11.5% balancing act truly hold steady in such an unpredictable world? It's the ultimate question for the state bank, and it's something we'll all be watching very closely as we navigate the months ahead. Thanks so much for joining me for this explainer, and definitely keep an eye on those global numbers, because as we've learned today, they invariably end up right in your wallet.